It's Friday, January 2nd, 2026. While you were sleeping last night, three things happened that broke the silver market. Number 1. Silver crashed 8 in 6 hours, from 78 at midnight to 72 by 6 a.m. Number 2. In Japan, physical silver dealers are still charging $130 per ounce. That's an 80 premium over the COMEX paper price. Number 3. The Federal Reserve just injected $8.3 billion in emergency overnight liquidity. That's the largest single-day repo operation since the March 2023 banking crisis. In the next 18 minutes, I'm going to show you exactly why this crash happened while you were asleep, why Japan's physical market never moved, what the Fed's $8.3 billion injection really means, and most importantly, what happens when Shanghai reopens on Monday morning. Because right now, we're in a 72-hour window where the paper silver market is trading alone, without China. And that window closes in 60 hours. Let me show you exactly what happened between midnight and 6 a.m. Eastern Time. Thursday, January 1st, 11:59 p.m., silver closes at 78.60. Markets are thin because it's New Year's Day. Most traders are off. Shanghai is closed for Chinese New Year. London is on holiday. Only COMEX and a handful of overnight desks are trading. 1:30 a.m., a large sell order hits COMEX. 2,400 contracts, about 12 million ounces, dumped in under 10 minutes. Price drops from 78 to 74. 3:15 a.m., another wave. 1,800 contracts. Price hits 72.50. 5:45 a.m., final washout to 72.15, an 8.2 drop from the midnight high. By the time New York traders wake up at 8 a.m., silver has already crashed and recovered slightly to 73. This crash happened during the lowest liquidity window of the year. New Year's Day. Shanghai closed. London closed. Thin order books. This is textbook stop hunting. Someone, likely a bullion bank or large fund, knew that retail traders had stop losses clustered around 75 and 72. By dumping contracts during the 3 a.m. hour when there are no buyers, they triggered a cascade of forced selling. And then they bought it all back between 72 and 74. How do I know? Look at the COMEX open interest data from this morning. Open interest increased by 1,200 contracts during the crash. That means new long positions were opened at the bottom. Someone accumulated 6 million ounces while retail was getting stopped out. This is manipulation in real time. And it only works when Shanghai is closed. Now here's where it gets interesting. While COMEX was crashing to 72, physical silver dealers in Japan didn't budge. At 3 a.m. Eastern, when COMEX hit 72, it was 5 p.m. in Tokyo, prime business hours. And Japanese dealers were quoting 128 to 132 per ounce for physical silver bars. Let me show you why this 80 premium exists and why it's not going away. Japan has 3 problems right now. Problem number 1, China's export ban. On January 1st, yesterday, China's silver export ban went into full effect. No silver leaves China for Western buyers. That includes Japan. Japan used to import 60 to 70 of its silver from Chinese refiners. That pipeline is now zero. Problem number 2, industrial demand panic. Japan is the world's 3rd largest electronics manufacturer. Sony, Panasonic, Toshiba, Hitachi, they all need silver for smartphones, solar panels, 5G infrastructure, EV batteries. These companies cannot wait for lower prices. Their production lines depend on securing silver now. They're panic buying at any price. Problem number 3, limited alternative supply. Where else can Japan get silver? London? The LBMA vaults are already draining. New York? COMEX silver is paper contracts. You can't ship paper to a factory. Mexico, Peru? Takes 4 to 6 weeks for new supply to arrive, and those refiners are already selling to higher bidders. So Japanese buyers are trapped. They need physical metal. They can't wait. And there's no supply. Result? They pay $130 for metal that COMEX says is worth $72. This is what a 2-tier market looks like. And here's the part that should terrify COMEX. If Japan is paying $130 and China reopens Monday at 90 to 95, that means the COMEX price at 72 is fake. It's a paper price that doesn't reflect physical reality, which means when Shanghai reopens in 60 hours, one of 2 things happens. Number 1, COMEX shoots up to 85 to 90 to close the gap. Or number 2, COMEX stays low, and the paper market completely detaches from physical. Either way, we're about to find out which market is real. Now let's talk about the elephant in the room. Why did the Fed inject $8.3 billion overnight? This is not normal. The Federal Reserve's overnight repo facility is supposed to be an emergency backstop for banks that need short-term liquidity. It's typically used for $1 to $2 billion on a busy day. Yesterday, $8.3 billion. That's 4 to 8 times normal. Here's what this tells us. Signal number 1, banks are under stress. When banks tap the Fed's repo window for $8.3 billion, it means they're having trouble getting cash elsewhere. Why? 2 reasons. Reason A, year-end liquidity crunch. Banks need cash to meet regulatory requirements on December 31st. That creates a scramble for dollars on January 1st and 2nd. Reason B, margin calls. When silver dropped 8 overnight, someone got margin called. Traders holding long silver positions suddenly needed to post more collateral. If they couldn't, they got liquidated. That forces more selling, which drops the price further, which triggers more margin calls. It's a death spiral. The Fed's $8.3 billion injection suggests that multiple banks needed emergency cash to cover these margin calls. Signal number 2, COMEX delivery stress. Right now, COMEX has 2,389 contracts standing for delivery in January. That's 11.9 million ounces of physical silver that traders are demanding. Normal January delivery? About 350 contracts. This is 6.8 times normal, nearly 7 times. When delivery requests spike like this, it puts stress on the banks that have to deliver the metal. Where do they get 11.9 million ounces? They either pull from COMEX registered vaults, which have been draining for weeks, or they buy on the spot market at higher prices, which squeezes their margins. Either way, it costs them cash. And when they run low on cash, they tap the federal signal number 3. This is just the beginning. $8.3 billion on January 2nd is massive. But here's what worries me. The Fed's repo operations are cumulative. On December 31st, they injected $5.7 billion. January 1st, another $3.2 billion. January 2nd, $8.3 billion. That's $17.2 billion in 3 days. This is not a one-day blip. This is a liquidity crisis building in real time. And it's happening at the exact moment when Shanghai is closed and can't provide physical silver to relieve the pressure. What happens when Shanghai reopens Monday and Chinese buyers start bidding again? The pressure doesn't ease. It doubles. Let me show you what's happening in the COMEX vaults right now, because this is the smoking gun. As of yesterday's close, COMEX registered silver, that's metal available for delivery, stands at 68.3 million ounces. Sounds like a lot, right? Here's the problem. There are 2,389 contracts standing for delivery this month. That's 11.9 million ounces. But total open interest across all COMEX silver contracts is 178,000 contracts. That's 890 million ounces of paper claims. So the ratio of paper claims to physical metal available for delivery is 890 million divided by 68.3 million. That's 13 to 1. For every 1 ounce of physical silver in COMEX vaults, there are 13 paper claims on it. Now, most of those paper contracts will never demand delivery. Traders roll them forward or cash settle. But what if even 5 demand delivery? 5% of 890 million is 44.5 million ounces. COMEX only has 68.3 million in registered vaults. And remember, 11.9 million is already spoken for this month. That leaves 56.4 million for future months. If delivery requests stay at this elevated level, COMEX runs out of silver in 4 to 5 months. And here's the kicker. The registered vault inventory has been draining. 6 months ago, COMEX had 92 million ounces in registered vaults. Today, 68.3 million. That's a 25.7% decline in 6 months. The drain rate is accelerating. In the last 30 days alone, registered inventory dropped 8.4 million ounces. That's the fastest monthly decline since April 2021. So let me connect the dots. COMEX vaults are draining. Delivery requests are spiking. The Fed is injecting record liquidity to keep banks afloat. And the paper price just crashed 8 during the one window when Shanghai couldn't push back. This is not sustainable. Something has to break. And it's going to break on Monday when Shanghai reopens. Let me tell you what I think happens next. Monday, January 6th, Shanghai Silver Exchange reopens after the New Year holiday. Chinese traders see that COMEX crashed to 72 while they were closed. What do? Two scenarios. Scenario 1, China follows COMEX down. Shanghai opens at 75 to 78, close to COMEX. Chinese industrial buyers see this as a gift and start panic buying. Within hours, Shanghai is back at 88 to 90. COMEX has to play catch up, and we see a short squeeze back to 80 to 85 by Tuesday. Scenario 2, China ignores COMEX completely. Shanghai opens at 88 to 90, exactly where it closed before the holiday. This sends a clear signal. The physical market does not recognize the paper price. Japanese buyers keep paying 130. Chinese buyers keep paying 90. Western dealers keep charging 95. And COMEX is left trading at 72 in its own little paper universe. This is the two-tier market scenario. And if this happens, the entire COMEX silver market loses credibility. Why would anyone trade COMEX futures if the price has no relationship to physical metal? Institutional traders start demanding delivery to capture the arbitrage. That accelerates the vault drain. And by February or March, COMEX faces a force majeure event. They literally cannot deliver the metal. Now, I'm not saying force majeure is guaranteed, but the conditions are aligning. Vault drain, check. Delivery spike, check. Shanghai detachment, in progress. Fed liquidity injections, check. All we need is one more catalyst. A refinery shutdown, a mining strike, a sovereign buyer like Saudi Arabia or China announcing a strategic silver stockpile. Any one of those events could tip this into a full supply crisis. Here's what you need to do in the next 72 hours. If you own physical silver, do nothing. You own the asset that's trading at 90 to 130 in the real world. The paper price at 72 is noise. Your metal is not worth 72. It's worth what a Japanese buyer will pay, which is 130, or what a Chinese buyer will pay, which is 90, or what your local dealer will pay, which is probably 88 to 92 after premiums. Do not panic sell into a paper market crash that doesn't reflect physical reality. If you want to buy physical silver, check dealer inventory right now. Premiums are 18 to 22 over spot. That means you're paying 90 to 94 per ounce for generic rounds or bars. Is that high? Yes. But if COMEX reprices to 85 to 90 on Monday, those premiums compress and you're paying fair value. The risk is that you wait for lower prices, COMEX stays at 72, and dealer premiums go to 25 or 30 because physical supply tightens further. Then you're paying 97 to 102. My advice, if you're planning to buy in January anyway, do it this weekend. Lock in current premiums before Monday's uncertainty. If you trade COMEX futures, this is the danger zone. If you're long, make sure you have 2 times your margin requirement in cash. The CME just raised margins from 25,000 to 32,500 per contract. I would not be surprised if they raise again to 40,000 or 45,000 next week. If you don't have the cash buffer, you'll get liquidated on a margin call even if you're right about the direction. If you're short, this is not the time to be greedy. The risk-reward is terrible. You might make another 3 to 5 if COMEX drops to 68 or 69. But if Shanghai opens strong and COMEX gaps up 8 to 10, you're facing a catastrophic loss. Cover your shorts, take your profits, and wait for a better setup. Here's the bottom line. We just witnessed the paper silver market crash 8 in 6 hours while the physical market didn't move. Japan is paying 130. China is about to reopen at 90. The Fed just injected $8.3 billion in emergency liquidity. COMEX vaults are draining at the fastest pace in 3 years. And we're 60 hours away from finding out whether the paper price or the physical price is real. This is not a normal market correction. This is a structural break. The silver market is splitting into 2 tiers, paper and physical, and the gap between them is widening every day. What happens Monday morning will determine whether COMEX can hold the center or whether the physical market takes over completely. Watch Shanghai's opening price. Watch COMEX's response in the first hour of New York trading. Watch the Fed's repo operations on Monday and Tuesday. And watch your local dealer's premiums. If premiums start spiking above 25, that's your signal that physical supply is locking up. If you want to own silver, the time to act is now, while the paper market is giving you a fake discount. Because once the rest of the world realizes that 72 is not the real price, that discount disappears. And you'll be paying 95, 100, or 130 like everyone else who needs the actual metal. That's where we are on Friday, January 2nd, 2026. The midnight crash that nobody saw coming, the 130 Japan premium that won't go away, and the 60-hour countdown to Monday's reckoning. Make your moves this weekend, because by Tuesday, the market will have already decided which price is real.